Mike, welcome. It's the August update. Happy to be with you on a nice September day here to discuss what happened in August and then look forward to what's coming in September. So quick headlines from the month of August here. Let's run through these real quick. On the Washington update side with infrastructure and social spending, tell us what we've seen so far and what we can expect.
Yeah, the House Democrats are taking sort of an all or nothing strategy at this point. So not moving on the infrastructure bill, which has bipartisan support, until there's more progress made on a much broader social spending bill. And the devil that's in the details is trying to get the moderate Democrats on board for the tax hikes that would be associated with the social spending bill. And all of this happened, talking about $3.5 trillion and so on and so forth, while the debt ceiling has been reinstated and the Treasury stated that they're going to run out of money to fund government operations by mid to late October. So it's all going to be very interesting to watch. The only thing we know right now for certain is that the Treasury net can't issue new debt, and that's sort of keeping a lid on Treasury rates. But once the debt ceiling ultimately does get passed, there'll be a lot of new Treasury issuance, and that should put upward pressure on Treasury yields.
Yeah, so speaking of Treasury yields, Jackson Hole occurred in August, and there's a lot of talk or a lot of not talk about the taper. And so what's the impact on markets?
Yeah, not a whole lot right now. Jerome Powell's speech, the new information is that tapering could start this year, so slightly sooner than we had originally thought. No idea what the pace of the taper of asset purchases is going to look like. And then also good news, made a point of saying that future interest rate hikes will not at all be tied to the pace of the taper. So at this point, it clearly does not matter. Markets took this in stride and just continued to move higher.
We've seen continued sort of downward trends in consumer sentiment, largely caused by the Delta variant.
Yeah, biggest decline in consumer sentiment since initial lockdowns in spring 2020. So consumer sentiment down. We're seeing the high frequency economic data, things like TSA traveler throughput, definitely rounding off and coming down. Delta variant impacting consumer behavior, certainly.
And on a positive note, an unreviewed study to this point out of Israel showed that natural immunity might matter.
Yes, study has not been reviewed yet, but has potential significant implications. If we can look at past cases and recoveries as having just as strong immunity as a vaccine, that could bring ideas like herd immunity back onto the table, which could be quite refreshing, sort of a light at the end of the tunnel, at a time when the Delta variant is really weighing on consumer sentiment, and it feels like we're just going to be dealing with this virus forever.
On the inflation front, something we thought a few months ago might be transitory is now appearing to be more permanent.
Yeah, the core CPI prints of 4% plus. We know we're not going to be seeing 4 to 5% inflation forever. That's going to be transitory. What now we're looking at is once we get over this transitory hump, where do we settle in? What's the natural run rate of inflation? And our view is evolving to we should be thinking about 2% as a starting point for core inflation. And the surprises are probably going to be on the upside in terms of what's happening with commodities, the global supply chain, and labor markets. And that is a very different environment than what investors are used to from the last 10 to 15 years.
So 2+ is the new 2. And let's take a quick look at the August numbers.
Yeah, we'll look at returns for various asset classes. Asset classes listed there down the left. We'll focus on the first colorful column on the left, month to date. So those are returns during the month of August. Plenty of green, another great month. It was relatively quiet in terms of things going on within the market. S&P 500 adding another 3% to its returns, now up over 21% year to date, making a number of new all-time highs during the month. Small caps having a bit of a comeback. They had stumbled for the last few months, so small caps getting a bid. Foreign equity also posting positive returns. Emerging market equities were the big loser in July, particularly the MSCI China index down about 15%. Definitely some dip buyers there as well, so some recovery. So all good news in the equity market. Interest rates were pretty range bound. So high quality bonds, things like the Barclays US Ag Bond Index, down about 19 basis points, but other areas of the market generating positive returns. And then not a whole lot going on in alternatives. So a pretty quiet month, as it should be. August, a lot of folks on vacation, volume relatively low. So not a whole lot going on.
Let's sort of bring all this home and talk through our outlook, our back to the future outlook, and where we've sort of, let's first talk about where we are today, and then we can talk about probabilities of bear bull and base case going forward.
Yeah. At this point in the year, we're going to say we're firmly in the bull case. I mean, you look at all of the price targets, U.S. GDP growth 7.5% for the year. We're probably going to be somewhere close to that, certainly higher than in the other two scenarios. U.S. inflation were there, Fed assets were there, S&P 500 price target of 4,400, we're past that. Mm-hmm. So it's safe to say we're pretty firmly in the bull case. What we think is more useful now is not, are we going to revert to one of these bear or base cases, because more and more information has come out during the year, but just, how do we wrap up the end of the year? What do we see from here? So these are sort of shades of the bull case, if you will.
And when we talk about the bull case, we're talking about through the end of the year and into the beginning of next year.
Yeah, the bull case, we'd have to overcome things like the virus, and we would have to get relatively dovish news from policymakers. So no big policy hiccups or mistakes. And, as long as those things were to happen, the market wants to continue to move higher. And so it most likely will do so. So specifically around the Delta variant and case counts in the US, if we can get cases to level off, if we can get hospitalizations and death rates to stay low or even, turn down, that would be great news. And if that can do anything to increase consumer sentiment, there's still plenty of pent up savings and demand to power us through something that could look like sort of a reopening trade 2.0 as we come into the holiday season. Folks saying, I'm going to have a big celebration and get with family members and travel for the holidays. I went really light on Christmas gifts last year. I'm going to do a little extra, whatever the case may be. So, and that in the U.S., but also globally, in the rest of the world as well. Vaccination rates continue to rise as we fight Delta. So if we can get that to happen, and then it's really, avoiding potential landmines around policy mistakes out of Washington and out of the Fed that would just allow the market to continue to move higher.
Right. So let's talk about that. The bear case. What are those things that would cause us to fall off the cliff here?
Yeah, the landmine. So out of Washington, the only real thing that the market doesn't like are the tax hikes associated with the social spending, particularly the capital gains hikes and the corporate income tax hikes. So, right now those look like those could move to pretty high levels. And if for some reason moderate Democrats all of a sudden became on board with these tax increases, and we actually got swift legislative action, and maybe even got these things to come into effect in 2022, or even the capital gains tax hikes to come into effect retroactively, that could be negative news. Pretty bad news. That's a known unknown. That's a risk that's underpriced right now. Mm-hmm. And also factoring in that would pretty dramatically change our future expectations for things like earnings growth if we were to see the corporate tax rate jump and the global minimum tax rate to get reinstated. As we discussed earlier, seems like a long putt to get all that done, especially by the end of the year.
Right.
Low probability event.
What about, let's turn to the geopolitical side. What about some of the stuff that's happening in China in terms of just their economy and their sort of pulling back from the global stage, and then potential for some conflicts, perhaps in Taiwan or other areas?
Yeah. Yeah, so China right now is focusing on longer term initiatives and sort of allowing these controlled implosions of credit to happen within the economy, because it's part of the longer term plan to take care of some of these issues. And right now, it seems like they have all the tools to continue to support economic growth while they're taking this strategy. But if they were to make a policy mistake, say if they were to rapidly overnight devalue the yuan, or greatly curb capital flows, or make any type of regulatory misstep that actually had lasting consequences, that's definitely part of a bear case to end the year. The U.S. equity market, as China has gone through these regulatory crackdowns, has really taken it in stride. So it would have to be something pretty significant.
Mm-hmm.
And then, a mistake or something, a big sort of known unknown that could be an issue is something like military action. So, don't know why over the next 3 months would all of a sudden be the time for China to do something like invade Taiwan. But those are always risks that are out there,
Right.
that we have to think about.
Okay, so sort of given those two bookends, what does the base case look like?
Yeah, the base case is still relatively rosy. So we're talking about shades of our full year bull case here for the next few months. So the base case is really somewhere in between. We see the Democrats likely starting to shift their strategy, go from something like an all or nothing to, hey, let's treat this infrastructure bill separate. That would be good news because that would most likely pass before the end of the year. And then, things like tax hikes and social spending, those being potentially on the table next year. So that the market would like that. That would be a crowd pleaser. In terms of the Fed, once again, erring on the side of caution, especially in relation to the Delta variant and how that might impact consumer behavior. So just taking an abundance of caution, going nice and slow with the taper, not talking about interest rate increases. The market would take that in stride and most likely move higher. And then related to the Delta variant, if we continue to see lockdowns not be necessary as we go through the fall and the winter, so lockdown stringency staying at these reduced levels, that most likely that falls into the base case as well. And all those things are generally good things. I mean, it once again, it's you can try to make a case right now to reduce equity exposure, but then you also have to talk yourself into owning cash, which gets you nothing, or owning high quality bonds, which earn next to nothing, and you lose money if interest rates rise. So, in this base case, if volatility will probably be somewhat low, you probably won't get, dips will be bought up somewhat aggressively. And so it's pretty good news.
Yeah, I think across the board, it'll be interesting to see as we go through. I mean, it's back to school time. And so as we see these campuses fill up, and I think we'll get a good sense of how the reaction function to Delta will change in the coming months. So that'll be something to watch. And thanks for this update. Thanks to our research team for all these great charts. And we'll catch up with you next month.
Thank you.